students. Today, we are on the verge of completion of the crash courses, and in this session, we are going to complete two major chapters and two major short units of macroeconomics for class 12. Here I'm going to cover today chapter 10, that is unit 8, government budget and the economy. Here we'll be discussing about the Indian government budget along with the objectives, its formation, its composition, and many more other things related to the numerical parts. I first start the meaning. Here there are some references which are there on YouTube channel, and there are many more videos supporting the financial budget presentation for the different years. I would advise you before studying this chapter to better understand the case study questions based on this chapter, you should go ahead with some of the YouTube videos which are all associated with the current year government budget presentation, so that you come to know about the various policies announced. Why am I suggesting this in the initial part of this chapter? As this chapter is completely based on the current affairs that's associated with the government budget presented in the month of February. There you may find some of the case study based question in the examination. So first of all, go ahead with the videos available on the various sources. Now, I would first start with the financial statements meaning or budgets meaning. Children, let me tell you very clearly that here we are just going to discuss about union budget. Let me tell you that there are three types of tiers of government in any country, that is the central government, state government, and the local government. All the three of them are going to present the budget. But in this chapter, we'll just study about the central government's budget, which is also known as union budget in India. What is the meaning of this budget? Budget is a financial statement including estimates of the government receipts and the expenditure during a fiscal year. Now remember, this is a pure estimation. It's nothing which has already happened. It is an estimation which is the government going to make for the related or associated receipts as well as the expenditures during a fiscal year. Let me tell you, fiscal year means financial year. It's a one marker also, which starts on 1st of April in India and ends on 31st of March. I repeat, and if you're a commerce student, you know it very well. Studying accountancy, you know what financial year is. So 1st April to 31st of March is the financial year. Now, I would like to introduce some fun facts to you about the government budget or union budget before I start with the serious part of this chapter. In India, the budget presentation is something very unique. You know, for long, it's been discussed first in the budget session of the Parliament House. In the budget session, the finance minister, along with the finance ministry and the various finance departments, come with the budget. Generally, the budget was kept in a short or small black color briefcase. So the finance minister coming in the parliament with that small sized or briefcase in black color was very much understood that this is the budget in the hand. But with the present finance minister, I know you're aware of it, that Ms. Nirmala Sitharaman is our present finance minister. You should be knowing this also, because this is also one marker. So, Ms. Nirmala Sitharaman, the present finance minister, has brought some changes to it. She is nowadays bringing a black color bag or a black color huge folder, you may say, which is comprising of the budget. When the budget is presented, that is generally 1st of February, it is presented and discussed in the parliament after the approval of the prime minister and the parliament house, both the houses in fact. It is then declared to the public, and it is implemented from 1st of April. In between, if there are any changes suggested by the houses, that is made. Overall, the finance ministry is going to be the one responsible for any kind of changes being accepted or not, or ultimately the prime minister. Then, once it is all properly done, discussed, approved, and finalized for the coming session to have a good start, to have a sweet start, there is a halwa ceremony. Now, you must be knowing a sweet dish which is known as halwa in India is distributed among the members of the parliament just to resolve all the issues and disputes they had within the session, and also to have a sweet start for the coming session. So for all these, within all these traditions, the budget is presented. Now coming to the serious part of this chapter, that is first the objective. What are the objectives? Children, this is a very, very, very important portion of this chapter. You need to remember that you will definitely face one or the other question from this portion. It can be a one marker. That means you may be given some situation or condition to identify the objective. You can also be given this in 3 or 4 mark short answer or the long answer of 6 marks. Definitely, it can be 1 or 2 objectives, or if into all together it is asked about the objectives, explanation of it, then you need to write all these objectives. So first of all, the objective is equal distribution of wealth and income. We know this very well that Indian government or any other government is the one responsible for the distribution of wealth in the country. How does the government plan it under the budget? The budget is also a provision for planning the coming year's taxes and the subsidies. So looking at the disparity in the society, looking at the difference or the gap between the rich and the poor, the government of India plans that how much of the tax should be charged or increased on the rich section of the society, on the well-to-do strata of the society, and that money which is collected through taxes, especially income tax, wealth tax, property tax, corporate tax, and many more kind of taxes. These taxes are further utilized in the welfare schemes of the people, especially the poor people. They're given subsidy on various causes. They're also given the welfare schemes, sometimes free education, free health facilities, free vaccination, and many more things are the part how the government of India tries to redistribute the income or equally distribute the income among the rich and the poor to resolve the problem of disparity. See, whenever anything related to the disparity or the gap in between the rich and the poor is given, you must understand that it is talking about the redistribution of or distribution of equal distribution of wealth and income. Then comes is a reallocation of resources. See, it is something which already has been discussed here in the first point, but it's a little different or slightly different. Reallocation of resources is not all about the fresh start. It is actually the one who are already in possession of something that has to be reallocated. That means if you have already allotted something or allocated some funds to some of the departments or some of the groups of the economy, you are supposed to take it back from them and you need to give it to the needy or more needy people. How is it done? Again, it is done with the help of the government welfare schemes like poverty alleviation programs, subsidy programs, and it is also done by charging higher taxes, that is direct and indirect, on the people. Direct taxes, as I just mentioned, that income tax, property tax, wealth tax, many more, whereas indirect taxes are GST and the other taxes. Now comes this economic stability. Children, remember that economic stability is completely in the hand of the government. Government has various tools. Yesterday, when we were covering the session related to AD&AS, there I told you that there are financial, that means monetary measures, as well as the financial fiscal measures, which are taken by the government to stabilize the economy. The major most enemy of the economy are deflation and inflation. Deflation and inflation in long run carry the economy towards higher recession or the slump, and sometimes they also carry it forward toward a higher jump of growth. See, neither a high recession or slump is good for economy, nor a very high growth rate or jump of the growth rate is good for economy. These two things make the economy unstable, and especially it comes from inflation and deflation. So the government of India makes stability in economy or tries to ensure stability in the economy, especially with the help of inflation and deflation. Now comes this economic growth. See, this is something which is basic, very basic. Without it, we cannot plan. Therefore, see, whenever the government is going to declare the budget, the first thing to declare is that how much of the growth rate they have planned for the coming year. Sometimes it is 7%, sometimes it is 8%, sometimes it is 9%. In fact, the government of India had the highest ambitious growth rate, which was planned, was for 14% of growth in the economy with almost 5 trillion turnover of the economy. But that could, of course, not be possible. We could not achieve it. But anything or everything associated with the growth in the economy, that means the growth in the GDP, per capita income, PPP, purchasing power parity, everything is declared with the help of the budget. And initially only it is budget. So in the initial phase of the financial year, it is announced, and after that it is checked whether it is being received or not. Then, very important thing. We know this very well that the government doesn't make only consumption expenditure, welfare expenditure, it also makes some investment expenditures. So there are some public enterprises which we read in IED, that I told you about BHEL, BHEL, SAIL, SAIL, ONGC, Oil Corporation of India, and many more, which are very important public enterprises, including LIC. We also had a word about LIC in the class. So all these important public enterprises, which are commonly known as PSEs or public sector undertakings, that is PSUs, are completely under the government. So their management, their funding, the input into them, the investments into them, changing the machines, meeting out the depreciation is also the work of the government. So all the investments related to PSEs are also done by the government of India in the budget. Suppose it is believed that now this year we need 200 crore rupees. So that 200 crore rupees will also be managed with the help of the budget. Now, regional disparities. We know this very well that India with multiple states and union territories is not having same or similar status of economy in all the states. Some of the states are highly developed. You see, Karnataka, Kerala, Andhra Pradesh, in fact, nowadays Gujarat as well, are all one of the developed states in India. Whereas if you talk about some of the states like Bihar, Jharkhand, Chhattisgarh, some parts of Odisha, Eastern Uttar Pradesh, they're all the struggling states in India. So when the government is making the budget and allocating the resources, they definitely ensure that they are going to spend more on the backward or developing states so that they get more financial assistance, they get more financial help, and they are on the path of the development. For example, declaring them SEZ, establishment of AIIMS you must be knowing, that is All India Institute of Medical Sciences. AIIMS is mandatory in one in each state and sometimes more than one in the state as per the population. Opening PGI, that is Sanjay Gandhi PGI Institute, that is what Post-Graduation Institute of Medical Sciences. So this, or having the metro rail projects, or having the infrastructural development projects, and many more things, which can definitely fight with the disparity or backwardness of that region. So how we reduce the regional disparities, I just told you. These are all the objectives. In some of the textbooks, you can also find one of the objective, that is employment generation or provision of employment. You see, when we are talking about growth, when we are talking about public sector enterprises, when we are talking about investments, then definitely there will be employment also. And in a country like India, where there is huge population, the government has to think of providing employment as well. So how and in which sector, how much of the poverty, how much of the employment can be generated is also one of the tasks under the objectives of the government budget. I hope this is clear. Once today only you should revise it with the help of your textbooks. to clear the complexities if there are any, although this is very easy, very scoring, and you can go ahead with this topic if it is there in the exam. Now coming to the structure or components of the government budget. Here, as I had just already told you, that government budget is nothing but the financial statement. And if you're a commerce student, you know this very well, that financial statement is all about the receipt and the expenditure. If you're not, then you should also remember that any financial statement, which is made up of two things basically, is the receipt, which is added, and the expenditure, which is debited. So the receipt part is all credited in the economy, and the expenditure parts are all debited from the economy. So I must rewrite this. It is actually debited. So you can write D. So it is credited and the other one is debited. So first thing is budget receipt and the second is the budget expenditure. And remember children, they are all planned. They are all estimated. They are not real. They have not yet taken place. Now the budget receipt is again of two types, that is revenue receipt and the capital receipt. Revenue receipt and capital receipt are they sound by their names only. The revenue receipt are those receipts or those estimated receipts. You can see that they are all those estimated receipts which do not add any liability or reduce any assets. See, these are the three keywords which you need to write every time in your definition. This is very commonly asked definition, that is receipt and the expenditure, especially revenue receipt, and the classification in the form of capital receipt, revenue expenditure, and in the form of capital expenditure. So believe that you need to write just three keywords and your answer will be believed to be correct. That is, they are all those estimated receipts which are not going to add any liability or not going to reduce any assets. For example, if you believe in such receipts, they are very much regular, they are very much recurring, they are not from any kind of future liability, or there is nothing future obligation being added to it, nor is the government going to make any reduction in the present assets of the government, like selling off any property and all. So they're all very recurring in nature, they are very regular in nature. It is something like हमारे खर्चे होते हैं when we as individual make the expenses, तो हमें रिसीट चाहिए. कहाँ से लाते हैं? हम खुद कमा कर लाते हैं, हम प्रॉफिट कमा कर लाते हैं, हम रेंट्स रिसीव करते हैं, and we also have money from various sources. So all those are the one which are recurring, they are regular, they are not very much surprising, they're not sudden. So these are all the kind of revenue receipts in the government budget also. There are two types of government receipts. See, this is a very, very important question, children. You need to remember this can be the 1 marker, also 2 and 3 mark question. The first is the tax revenue receipt and the second is non-tax revenue receipt. The tax revenue receipt are of two types, that is the direct taxes and the indirect taxes. Direct taxes, the definition. The direct taxes are those taxes which are not going to add on the burden on anybody else, but only on the payer. Means the burden of the paying tax is going to be only taken by the taxpayer. Whereas indirect tax is something where the burden is going to be transferred on somebody else. That means the burden of paying tax is not taken by the one who is paying it to the government. Secondly, direct tax is directly paid to the government, whereas indirect taxes are never paid directly to the government. They always are paid to the government through third party. I'll explain you how it happens. Direct taxes, for example, and see, all those direct taxes and indirect taxes. From my side, there is a task to you that make a list of direct and indirect taxes. I always give to my students in the class, they during this chapter make a list, a detailed list of comprising of at least 25 of the taxes. So include all the common and prominent in direct taxes and indirect taxes and make a list and learn it, because this can be the 1 markers. Now the prominent direct taxes are of course income tax, wealth tax, corporate tax, property tax. See, if you hear them all carefully, whatever taxes I'm just now calling, income tax, wealth tax, corporate tax, property tax, production tax. These are the taxes which are directly paid by the person who is liable to pay it. And they all pay directly to the government. For example, ask and talk to your parents. If they are having any kind of income, suppose your mother is working and your father is also in a job or is involved in some business or some other economic activity, they must be filing the ITR, income tax return. That means they must be paying some part of their income to the government in the form of the tax, which is known as income tax. In the same way, the wealth and the property they possess, for that also they need to pay the taxes to the government against the property value. Corporate taxes are paid by the corporate houses. These are the taxes which are paid to the government again directly for the profit they are earning. That is against the profit, I repeat. Now, there are many other direct taxes which you need to remember. Now comes is the indirect taxes. See, after the implementation of GST, GST is the major indirect tax in India. We had already discussed this in the last topic. Other than that, that is service tax, VAT, entertainment tax, octroi, the different duties like import duty, export duty are all the part of the indirect taxes. Now, these are the taxes which are never paid directly to the government by the payer, and the liability is never on the payer. See, I just give you the example. Suppose you go and eat in a restaurant, check the bill. The bill which you get, there in the bottom of the bill, you will get the estimation of the GST. SGST and CGST both are added. Now, the bill which you're paying along with the GST, and that GST you're paying to the owner of the restaurant. Now, the owner of the restaurant is going to collect all the GST from the consumers or the customers, and that GST is going to be forwarded to the government of India. So you see, who is bearing the pain? The pain is being borne by the taxpayer, and the taxpayers are not directly paying it to the government. It is being paid to the government by somebody else, that is the third party. Now comes is the non-tax revenues. Children, you need to learn each and every word out of it. You definitely need to learn. They can be the one markers and they can also be the long answers. So that question is asked like, what are the different non-tax revenues of the government? The first is fee, license, and permit. You see, for various kind of permissions, for various kind of license, for various kind of permits, sometimes for various kind of approval by the government, we have to pay the fee to them. Other than this, sometimes for the government services we are receiving, we pay the fee to them. For example, we pay fee to the government offices, government officials. We also pay the fee to the schools, hospitals. We pay the fee in the court and all. We give the charges for license, which we take like vehicle license. We also take license for or permission for the production. We also take the license or permission for the import and export. So for that also we need to pay the license charge or license fee to the government. We also take permit. There are various kind of permits for the sale and purchase, for establishment of production and possession of anything. These permits also need the fee. For example, if you have a taxi which has a permit to run on the road in the form of a taxi, for that also you need to pay the charges to the government. So various fee, license, and permits are going to be the part of the non-tax revenues. Then comes is fines and penalties. I'm first covering the simple one, which you know, which you already have heard about. Fine are those, or penalties are all those fund or the money which is charged against some punishment. See, generally you must have heard in television or some movie or some series that when the court is ordering some punishment, they also charge some fine on the guilty, like fine of 50,000 rupees or 2 lakh rupees. So all these penalty or fine are also going to the treasury of the government. Gifts and the grants. The government receives various kinds of gifts from the NGOs, non-government organizations, sometimes international organizations like UNICEF, UNESCO, World Health Organization. Sometimes the NRIs living in different parts of the world, that is non-resident of India, they also give some gifts and the grants to the government. And now some difficult one. Listen to me very carefully. The escheats first. Escheat are all those income which is earned by the government from all this property and assets or the fund which is left behind by somebody, which is nobody there to claim for. Suppose there is a property or there is a land piece, but there is nobody to claim for. That means the owner has no heir, or sometimes because of some technical reasons there is nobody to claim for, so that property is automatically transferred to the government. In the same way, there are many more things like various bank accounts which there is nobody to claim about, the bank lockers which nobody is going to claim about, so they are all as sheets and transferred on the name of government. Special assessment. Here, when this infrastructural development is made by the government, and because of that, if property value is revalued and it gets better value, so the people who are living in that particular property or who possess that property have to pay some charges to the government, which is known as special assessment. Income from PSUs. Various PSUs are profit earning. We discussed about BHEL, ONGC, SAIL, and many more are there which are earning good profit for the government. They are also the non-tax revenue for the government. Like Coal India is also one of them which is running very good profit. This is one of the mini Ratnas in India. So mini Ratnas and the Maharatnas, the parts of PSUs are earning good profit for the government of India. Now, 4 features of bond. See, when there is a surrender of bond in premature time, see, this is a complicated process, so listen to me very carefully. When the government is selling out the various bonds, like gold bond is there, securities are there. So all these bonds and securities which are in the hands of the banks, that's commercial banks or the consumers, if they want to get this cashed before time or before maturity period, so the government of India charges some of the commission on it or the penalty on it, which is again the income for the government of India. So these are the various non-tax revenues, but these including tax revenues, this is the major most collection sources or revenue source collection for the government of India, that is tax, especially the direct tax. This is leading, this is always having a position of star in the government revenue. So this direct tax is having the major source of earning, whereas the various are the contributor, or as I just named. Now coming to the expenditures, the revenue expenditures. See, just like the revenue receipt, there is also revenue expenditure. This is here, the revenue expenditure. The revenue expenditures, I would now in detail discuss about. The revenue expenditures refer to all those expenditures which are neither creating any assets, that means they are not going to work or help in any of the asset creation or construction, and they're also not going to reduce any liability, that means the repayment of back loan or the installment payment of the loans taken back. Okay, there are also recurring in nature. Basically, they include or comprise of all the normal expenditures made by the government. See, government is a consumer, government is an investor, and the government is an agency which is going to fulfill all the requirements of the government. So what are they? First of all, normal payments made by the government. Normal payments like especially salary. The salary is paid to the people hired by the government. There are many agents, there are many departments, there are many faculties, there are many various officials working under the government. They all receive the payments from the government. Then the government also provides various kind of government services, like we have police, we have army, we have security system, we also have paramedical, we have we have paramilitary, we have the medical field, we have education. All these systems which the government is earning, the government has to make the investments in these services also. Now, the government also has to make the rent payment or interest payment other than payment of COE, that is compensation of employee, means giving the payment to the employees of the central government. The government is also going to make payments in various other aspects like the payment for the interest and the profit, COE, and the payment for the rent and the interest. Other than that, the government is also going to have some other recurring expenses like payment of the interest, as I have already mentioned. See, the government has long back taken a lot of loan from the international sources or sometimes national or domestic sources. The government has to pay the interest on it, which is recurring in nature. The government also has to make some recurring expenses like payment of electricity bill. The government also has to arrange the fuel. The government has to make arrangements of a stationery, the fooding for the various departments like parliamentary house and all. So these are the recurring and the natural expenditures. In fact, the majority of expenditure made by the government of India is on the defense of your country. So other than defense, there is education, there is health facility, which is also given by the government of India. Other than that, there are some diplomatic reasons also on which we are making the expenditures, like supporting our neighbors and many more things. They're all recurring expenditures. Now coming to the various kinds of capital sources, that is capital receipt and capital expenditure. The capital receipt or expenditures are all about the liability and the assets reduction. That means the capital receipts are those receipts which are going to create the liability or they are going to reduce the assets of the government. That means if the government has to sell out some of the property or the government has to make the loan indirectly. So they are definitely not recurring in nature. They are urgent in nature. Urgent in nature, this means whenever there is lapse or the loss in the budget, the government takes the shelter of the capital receipt. Now, there are various sources of the capital receipt. The first, of course, comes is borrowings. See, first of all, the government tries to borrow the money. Now, where does the government borrow the money from? You studied in the chapter Money and Banking that central bank is the banker to the government. So of course, whenever there's lack of fund, the government is going to take or arrange the fund from central bank. Sometimes they also borrow the money from international sources. Sometimes they borrow the money from the public, which is known as public borrowings. So there are various kinds of borrowings, and all these borrowings are going to create a liability on the government. Because they're going to create a liability on the government, they are the capital receipts. Then recovery of loans. See, sometimes the government pays some of the loans or gives some loans to the states. Like the central government may give the loans to the government of Delhi or government of Gujarat or government of West Bengal. So at the time of need, the government can ask for this loan amount back. So when the government is recovering the loan, that is also known as the capital receipt. Now you must be wondering, अपना ही पैसा वापस ले लिया, तो how is capital receipt being created? Yes, it is capital receipt. I give you an example for this. Suppose I have given 1 lakh rupee to my one of the friends, which is lying safely there, and I am still in the possession of that 1 lakh. That is my asset. But when I am in need, I'm asking that 1 lakh rupee back from my friend. I'm saying, nahi, mujhe wapas chahiye because I'm in need of it. As soon as I take it back, I'm actually withdrawing my asset. There is withdrawal from my asset. मेरे 1 लाख रुपए कम हो जाते हैं जो पड़े थे कहीं सेफ पड़े हुए थे as an asset. और मैंने वो 1 लाख रुपए लेकर खर्च कर दिए. So this is nothing but reduction in asset. I repeat, children, this is nothing but reduction in asset. So when there is reduction in asset, with the help of recovery of loan, that is also capital receipt. Then comes is the others. Others in comprises of disinvestment cost. Major more. Disinvestment nowadays been very common. I told you that day when I was teaching ID chapter disinvestment topic, I talked to you about the license. License is, I'm sorry for the interruption. LIC. LIC's disinvestment, other than that, the disinvestments made in many of the PSUs. What is disinvestment? The part sale of the company, or there is sale from the PSUs, but it is partial, not complete. So when partial sale is done for the PSUs, this arranges some fund for the government. So these days, disinvestment has been major source of income for the government. Other than disinvestment, the government also asks for the investments from the other country. Like you see, when our Prime Minister joined the office, he went to the various countries and asked for the investment. Right from America to Japan, he visited from west to east everywhere to ask for the investments. So all these investments which are coming from the rest of the world are also going to be the capital receipt. as some way or the other, they are going to create some kind of liability on the economy. Then, other than this, there is something which is officially not existing as per the government of India that is being already withdrawn. So, what is that? That is something when the government of India asked the RBI to issue additional currencies. This is known as deficit financing. The deficit financing is something when the government of India asked the RBI to issue the additional currency against the reserves which we already have. So this deficit financing is something again going to create a liability on the economy. Therefore, it is also part of the capital receipts. And the last, sometimes we also disturb our foreign exchange reserves. So when we are short of fund or we need the money, we also affect and disturb the foreign exchange reserves we have. So that is also going to reduce the asset of the government, and therefore they are known as capital receipts. See, revenue receipt is very simple and direct to understand. That the capital receipt are a little complicated to be remembered. So you remember it very well. There are three basically: borrowings, recovery of loan, and others. Under others, you can write 4 points. That is disinvestments, investment from the rest of the world, effect on the foreign exchange reserves, and also the deficit financing, which officially doesn't exist. But yes, unofficially it is, still does. Then comes is the budget expenditure. As I have already told you about the revenue expenditure, now I'm going to tell you the capital expenditure. The capital expenditure is something, or the capital expenditure refers to the types of expenditure which are either going to create some of the assets or they are going to reduce some liability. That means you are either going to reduce the burden of the past loans or the debts you had taken, like repayment of loan, repayment of the loan installments are the part of capital expenditure. Now, building or expansion of the infrastructure. See, when you are expanding the infrastructure or when you're making some of the resources like bridges, there are metro rail projects, there are train railway projects, there are some airways related projects. So these are the expansion of infrastructure. What are they called as capital infrastructure? They are capital expenditure. They are known as capital expenditure because they are going to create the assets. All these things, like long back, we purchased the Rafale fighter planes from the other country. So the purchases of such fighter planes or defense arms or ammunition are all going to be the part of the creation of assets. Therefore, such expenditures will be the part of capital expenditure. Now, the investment. See, the government also makes the investment, national as well as international. National, you know, we have talked about PSU so many times. International. The government of India has made a lot of investments in all our neighboring countries, right from Afghanistan to nowadays very much we are talking about Maldives. That government of India has made a lot of investments in Maldives also long back and still been making. So all these investments made in the rest of the countries, in the rest of the world, they are also the part of the asset creation, and that is why they are also the capital expenditure. I hope all the four components of the government budget are clear to you. They're generally individually asked and they are given in the case to be identified about. Means you will be given a condition and you will be asked to identify this. So this has to be taken very, very seriously. Now, children, I would like to tell you certain or additional information about the government budget. See, when it comes to the types of budget, I repeat, children, when it comes to the types of budget, there are various kinds of budget. One of them, of course, is based on the structure, that is revenue budget or capital budget. The second is on the basis of the expenditure we make, that is planned expenditure, unplanned expenditure. So the parts which talk about the planned expenditure, they are known as the planned expenditure. And sometimes when we talk about unplanned expenditure, they are all unplanned expenditure. Now then we talk about the losses and the nature of the budget. See, generally when we are making the financial statement, in the end of the financial statement, either you are in surplus or you are in loss, or you make a balance. So when you are making a balance in the end of the financial statement, that is known as the balanced budget. When you are in surplus, that's known as surplus budget. And when you are in deficit, it is known as deficit budget. Now there's a question that which budget is good and why. It's generally a question that which budget is good and why. You generally think that balanced budget is an ideal budget and is the best budget. No. Let me tell you that always the balanced budget is not the good one or the best one, as it is going to create many kinds of checks or controls over the expenditures which the government should have made. So the best budget is the surplus budget. Why surplus budget? Surplus budget means that the government is making a lot of expenditures. And where is the expenditure being made? On the growth of the economy. Therefore, surplus budget for an economy like India, which is a growing economy, is considered to be ideal one. Now, there are three types of measure to measure the deficit. The first is primary deficit. Sorry. The second is fiscal deficit, and third is revenue deficit. Please note it down, and I'm sure you are aware of these formulas. The primary deficit is the deficit which has already been created because of the past debts or the loans. So it is all about the fiscal deficit minus interest payment. Now, fiscal deficit is the total deficit in the budget, which is all about total expenditure minus total receipt excluding borrowing. And when it comes to the revenue deficit, it is only about the revenue part. So it comprises of revenue expenditure minus revenue expenditure. One tip over here, if you're being asked, it's a very rare question, even then if you're asked to calculate the budget deficit, and it is especially about the fiscal deficit. Remember, if in the question you're already given about the borrowings, so borrowings are equal to fiscal deficit. I repeat, borrowings are technically equal to fiscal deficit. So just find the value of borrowings and you find the value of fiscal deficit also. Here I wind up this part of this unit and I'm starting with the next chapter. That is foreign exchange. What is foreign exchange? It is the currency of any other country. That means if for us INR is a home currency, then any other currency like US dollar, pound, sterling, dirham are all known as the foreign exchanges for us. Now there is an exchange rate. What is this exchange rate? The foreign exchange rate is the rate at which one currency is exchanged with the other currency. I repeat, foreign exchange rate is the rate at which one currency is exchanged for the other currency. And where all these activities take place? These all activities take place in foreign exchange market. What is this? This is not a physical place, but it is a place where the buyers and sellers are present. See, long back it was all about meeting, contacting, but now it's not so because that everything can be done on a phone call also. So the marketplace or the foreign exchange marketplace is something where all the buyers and sellers are present in the terms of exchange of the foreign currencies. Now, there are various kinds of exchange rate. The first is the fixed exchange rate system. I repeat, children, the oldest one and the first one is fixed exchange rate system. The fixed exchange rate system is the system in which the exchange rate was fixed by the government. So the first exchange rate under this which was adopted was gold standard. It's a very common, very popular and long run system. It's a very common and very popular system where every government declared the exchange rate as per the standards of the gold. For example, if 1 USD can buy 4 grams of gold and 1 pound can buy 2 grams of gold, that means the value is not equal. Here you can see that dollar USD is weaker than pound because pound can buy more gold with lesser money. Oh, I need to speak in different way. That is, $1 is able to buy more of the gold. That's 4 grams of gold. That means the exchange rate here will be fixed as 2 pounds will be exchanged for $1. I repeat, $1. So what is it? This is the exchange rate. Now, then comes is the Bretton Woods system. See, long continued was the way for gold exchange. Means we took gold as the measurement, but it was not good for economies. Why was it not good? We were keeping the gold blocked, and the governments were trying to reserve more of the gold to make their currency stronger. Therefore, the various economies met in a place known as Bretton Woods. I repeat, many of the economies met at the place known as Bretton Woods in the year 1944 in a conference developed by United Nations. There they came on a conclusion that instead of gold and pegging the currencies against gold, it's better we peg the currency against something else. And what was that common thing? That was US dollar. They all agreed upon exchanging their or pegging their currencies against US dollar. That means this time the standard of exchange was fixed as to be US dollar. That means if $1 could be purchased with 100 rupees and $1 could be purchased with 10 pounds. So 100 rupees becomes equal to 10 pounds. This is how the exchange rates were fixed. That means they were fixed or pegged against the US dollar. From July 1st to 22, this decision was taken in New Hampshire. This is one marker, therefore I am emphasizing over in the year 1944. Now comes is flexible exchange rate system. Children, this is very important, and this is the most current system. This is the system which every economy has adopted nowadays, because long run Bretton Woods system or the fixed exchange rate system against USD, the government started feeling cheated because the USD was becoming stronger and stronger because of excessive demand in the world platform or world market. So they decided to go ahead with the flexible exchange rate. Now, what is this? The flexible exchange rate system of currency is the system in which the exchange rate is determined with the help of demand and supply of the foreign exchange. Here, children, you need to remember the exchange rate with the help of the demand and supply concept, which you studied in class 11. There you studied that price is determined of anything at the place where there is D equal to S, or where the demand curve is intersecting supply curve. In the same way, here you can see that this demand curve, which is downward sloping curve, and supply curve, which is an upward sloping curve, they are intersecting each other at point E. And this is the rate which is fixed between the two currencies. So from O to R is the rate, and O to Q is the quantity of the foreign exchange which the country is ready to demand and the other country is ready to supply. So this is known as flexible exchange rate system. Children, whenever you are asked about the flexible exchange rate system, the flow of the answer should be, first of all, write the meaning, then make this diagram, and then explain the diagram description as given on there in the paragraph. Or you can write in your own words. You are not at all bound. Just make the graphical presentation and explain it on your own ways with the labeling, proper labeling of the diagram. Now, the other question which is asked out of this chapter, what are the sources of demand of foreign exchanges? This you already know. This is nothing very different. It is something which we come across in our daily life. Just imagine that why would a person demand for a foreign exchange or foreign currency? Or why would a country demand for? So first of all, let us talk about the country. A country demands for the foreign exchange when they have to make the payments for the purchase of goods and services. For example, India purchases crude oil from the rest of the world. And for making of the payment of the crude oil, the government has to have the currency in which they have to make the payment. The government also asks it for the financial assets. Excuse me. The government also asks for the financial assets purchases. Like if the government has to purchase some assets in different parts of the world, so for purchasing that assets or investing or purchasing the shares or bonds or securities, they need the currency. That means the foreign currency. So they will demand for the currency. Now, why does the individual believe to have this? Why do they want? When they have to want a direct investment, like they want to buy a shop, they want to open up a factory, they want to buy a building, they want to buy a house, then they need the foreign currency. Or they want to send the gifts and grants. Suppose somebody's child is studying abroad, so they have to make the expenditures, they have to maintain the expenditures, or their relatives are living abroad and there's a marriage or there's function, they need to send the gifts. For that they need the foreign currency. Of course, somebody living in UK, you cannot make the payments in rupees, you have to definitely arrange the US, you definitely have to arrange the pound or US dollar. If somebody living in the different parts of Europe, you need to arrange for the European dollar. So there are various currencies which are required for the various parts of the countries you need. Now the next is when you are going to have a foreign tour. For different type of foreign tours also you need the foreign currency. For example, business tour, educational tour, official tour, and recreational tour. Any kind of tour also you need the foreign currencies. So these are the basic needs or demand sources of the demand. And vice versa is the supply. Means जिस चीज के लिए आप डिमांड कर रहे हो, just make it opposite, and this becomes the reasons for the supply of the foreign exchange. As it is written that when the foreigners are purchasing anything from your market, when the foreigners are making direct investments in your market, when you are receiving the remittances from the rest of the world, you receive the foreign exchange. When the NRIs are sending money home, they are making investments in the home country, then also we get the supply. When we export goods and services to the rest of the world, we get the supply. And also when the people from our country from the people from other country are coming to India, they are living in India, they're making investments, they are purchasing properties, assets, they also make investments in the foreign currency. So these are the sources of supply of foreign exchanges. Now comes a very, very important concept, which is a 1 marker as well as a 3 marker, can be a part of the long answers also. Depreciation and appreciation. As we just talked about the determination of exchange rate with the help of the demand and supply. So when a currency is being determined against other currency and a currency is having a higher value, that currency is said to be appreciated, whereas the currency which is having a lower value is known as to be depreciated. I give you one example. Suppose we can buy 1 USD for 40 rupees. Now suddenly for buying $1, we have to pay 50 rupees. You see, for buying single dollar, now we have to spend what we were spending earlier. We have to spend more than that. That means earlier we were spending 40 rupees. Now we are spending 50 rupees. So in this sense, our rupee, that means our INR has been depreciated. Its value, its foreign value has fallen. Whereas when we are spending more to buy a dollar, that means पहले कुछ कम करना पड़ा तभी ज़्यादा. That means our USD has been appreciated. I believe that you have understood. I explain it again. Listen to me very carefully. When a particular currency becomes expensive against the other one, it is appreciation. When the one or particular currency becomes cheaper against the other currency, becomes depreciation. I gave you the example. Now, the reasons for appreciation, depreciation are, of course, demand and supply. When demand is high, the currency is appreciated. When supply is high, the currency is depreciated. I repeat, when demand is high, the currency is appreciated. When supply is high, the currency is depreciated. Impact of the depreciation and appreciation. Listen to me very carefully. I'll just tell you in a very simple way. They have effect on only two things, that is import and export. Let's start with appreciation. If a particular country's currency is appreciated, exports rise and imports fall. Now, you must be wondering why. Exports become high. Why? If any foreign investor has to invest in India and was able to purchase something for 5,000 USD, now will be able to buy the same things for 4,000 USD. This means the purchasing capacity of a foreigner becomes higher when the currency, their currency is appreciated and ours is depreciated. So what they will do is they'll be investing more in our country. Whereas when our currency is depreciated, the things become cheaper for the rest of the world. So they will be buying more from India. So our export is also increased. Whereas if you talk about the appreciation of our currency, if our currency is appreciated, comparatively investments become expensive and also the goods become expensive. So neither the investors will come to us nor the importers will buy the things from us. So you know what? It sounds very good. Appreciation sounds very good and it is very positive, something very much strengthening to the economy. But in fact, the positive effect is created by depreciation. And therefore, if you remember, I told you in IED that the government of India at the time of liberalization, privatization, and globalization had intentionally depreciated its currency to encourage, to promote exports from our country. Now, coming to the last topic, that is managed floating rate. Managed floating rate is something where basically the market forces, that means demand and supply, responsible for fixing the exchange rate, but with a little intervention of the government. The government doesn't directly intervene. It is the central bank which actually intervenes into this fixing of the exchange rate. So with a minute intervention of the central bank of a country, the new exchange rate is fixed. And this somehow helps in fluctuations or controls in fluctuation. This is sometimes very important for the economy, but because it is against the ethic or ethical rules of the market, it is known as dirty floating rate. I repeat, it is also known as dirty floating rate. So managed floating rate's other name is also known as dirty floating rate. It is because it is unethical. It is against the government norms or market norms. And you see various currency wars. What are they? They're actually about all these things. Deliberate depreciation of the currency to encourage exports. China has done this many a times, although they do not accept it. They have many a times fluctuated or affected the foreign exchange rates by depreciating their currency so that they could export more in the foreign currencies, in the foreign countries, and could occupy the export markets. This is all done by them with the help of managed floating rate. And that is why it is also known as dirty floating rate, where there are dirty tricks adopted by the government. That's it. We have covered this short but very important topic. For this chapter, you just need to study about two things. You need to study about the various kinds of exchange rates, how they are fixed, and the effect and impact of the appreciation and depreciation. So if you are through with these two topics, that means you are done with this topic as well. Thank you so much for today's session.